Wall Street Window podcast. I got a very special guest with me today. I'm speaking with David Skarica, who runs the website addictedtoprofits.net. How you doing today, Dave?
Pretty good. Actually, really good. Some things have been going on here. I haven't been that active on my website. You just talked about it, but I've been doing a lot of venture capital, and I'm setting up another little side venture. And as you know, too, I'm doing some renovations in my house in the Bahamas. So that's a job in itself as well. So we're just starting on that. But anyhow, yeah, no, things are going good, and I really am looking forward to 2020. This year was a good year. It hadn't been the greatest the last few years, but with kind of gold breaking out, even during this, even at this consolidation, it's still well over 1,400. I really think that next year is going to be a fantastic year.
Well, one thing about gold, I know, gold has pulled back since Labor Day. The GDX has pulled back. And so many people in the United States only trade exchange-traded funds. They try to jump in JNUG and Dust and these sort of things. And to those people, it seems like gold and mining stocks are just collapsing or something. But in reality, it's just a little bit of a pullback. And small caps, the right ones, are taking off. I mean, as we're speaking today, Aftermath Silver is at a new high.
Yeah. The thing is, I think, like, when you look at it, these companies, if they can keep their costs in line in terms of production, or these exploration companies, there's a huge difference between gold at 11 to 1,200, where it was kind of floundering for years, and gold at over 1,400. That extra, say, $250 to $300 in price really can go to the bottom line and really makes a lot of projects more economic. And I really think over 15 to 1,600, if we break out of that next year, you're going to really see the junior market in these gold stocks move, because that's where I think you'll really see the leverage and them being able to make money on those prices. But yeah, I really think here, even if it just sat here for a while, I think that the quality companies and companies with certain assets, at over 1,400 gold, at over $17 silver, these companies can make money here, and especially the ones that are well run. And you've seen it too. We've seen it like I said, I do some kind of venture capital and help these companies raise money. And it's like, I've really seen the difference in the precious metals in the last 6 months. It's been easier to raise money. People have more interest in it. Maybe that's also a side effect of, the gold breakout combined with, the other sectors that were quote unquote the hot sectors. Crypto collapsed in 2018. Marijuana stocks mostly collapsed this year. So maybe, gold is kind of, even though the macro stock market's doing well, but in these kind of small caps that we work with, really gold and precious metals are like the only game in town with the collapses and kind of the prices of these other sectors.
Well, I'm excited about these stocks, and I'm hoping next year to find more stocks. Both of us are in Aftermath Silver, but I'm hoping, I expect it'll continue to go up more from here, but I'm hoping next year we can find some more like it, and that'll really set up for some big gains. But a lot of people just look at the ETFs, as I was saying, and especially in the United States, and they really are focused on the SPY ETF for the S&P, IWM, and those have made new highs. What do you think is going on with the broad stock market?
Well, first of all, if you look at and the stocks have been overvalued for years, but due to low rates, the amount of cheap money we have sloshing around, we have been able to prop up the stock market. And let's face it, some of Trump's policies, like the corporate tax cut, did kind of give a second wind to the economy. We probably without some of those, but it's kind of like maxing out your credit card because the deficit's blown up too, and of course government spending is one of the things that's factored into GDP. So I think if Trump wasn't elected, we might already be in a recession, but it's not like it's long-term self-sustaining, because you're really going to I think at some point when you max out your credit card at some point you got to pay it. So probably after the election we'll see the negative effects that kind of putting growth up front. But anyhow, in terms of what's interesting about it in terms of the market cycle is I just finished writing an article for one of the publications I write for called Financial Intelligence Report. And I'm going to add this into one of the chapters in my new book, which will be out in early to mid next year and middle of next year. And what it is, if you always have these decade-long trends, it seems. Now, stock market, being as we know it today with the Dow Jones, only really started trading in the 1890s. But if you go look at it, it really started in the 1920s. Of course, you had the Roaring '20s and the big bubble and boom, and then that ended in '29. And then we had this crash. And then the 2-decade secular bear market ended in '49. There was like a post-war recession. And then, of course, then we had the boom in the '50s and '60s. And in the '70s, we had this decade-long boom, but it was in commodities and inflation. And that ended in 1980, January 1980, with 1979 seeing the year where gold blew off. And then in the 80s, we ended the secular bull market in Japan. And Japan, same thing. In 1989, had this huge end of the decade bull market. And then in the 90s, Nasdaq, 99 and 2000 had the blow off. And I think and even in this last gold move, it lasted 2011, but really after the financial crisis, there was a nice little blow off from 2009 to 2011. And I really think now this decade-long stock market, kind of like the 1920s, is seeing this end of, or the Nikkei 1989, Nasdaq 99, as I just mentioned, is seeing this decade-long blow off. And one of the reasons I wasn't that bearish on the market this fall at all, I've always talked about hedging. I actually had probably the least amount of hedges I've had in years. Partly because gold and precious metals are moving, but partly because they just didn't have that feeling the market was going to tank. And partly was when I look at the huge bull market, another big bubble, you look at stock market, market capitalization, the GDP, all of these things nearing the 2000 highs, extreme valuations, price to sales of companies on the S&P. I was just like, if you have this kind of bull market, it's probably just not going to end with a rolling top, right? You're probably going to see some kind of blow off. And now that we're in the fourth quarter, people have to kind of chase returns. Like if you're a hedge fund that did try to say short the market, thinking there was going to be some kind of collapse or decline this fall, now you're chasing these stocks to try to make up for that. And that's often the case when the market doesn't drop by, say, October or so. And I think we're in the fourth quarter blow off. I think this is like 79 in gold, 89 in the Nikkei, 99 in the Nasdaq. I think this is really the end. Now, you don't know when it's going to end. And in the case of the Nasdaq, it didn't peak till March of 2000. In the case of the Nikkei, it peaked on the last trading day of 1989. In the case of gold, it peaked in mid-January of 1980. So we don't know when exactly it will peak, but probably if this is one of those, like it'll end up being the roaring 2010s, right? If this is one of those decade-long trends, it probably will, probably top sometime in the first quarter next year. And if you look at the geopolitical background and the economic growth background, that makes sense, because either if Trump gets reelected, he won't be able to do all this fiscal stimulus, and he won't have the Fed cutting, to kind of keep this thing going past the election. I think the market will begin to sense that. Or if it looks like a candidate like Elizabeth Warren or kind of one of these far left candidates who are going to implement more socialistic type measures, which should hinder growth, I think the market will start to worry about that, and that could cause it to roll over. So I think sometime, it's always hard, we're talking about a nearly 11-year bull market. So trying to call the top of that is extremely difficult. But I do think sometime next year, we could finally see the blow off in top of this thing and then a rollover. And I think one of the things to note is, even though the GDP numbers came in a little stronger than expected today, the revision for the third quarter, is that we are seeing slowing in the economy. We can see that. And it's not just due to trade. It's just, it's just, again, we're in this 11th year, 10th year of an expansion. You just start petering out at some point. And I think if you see the economy really weaken in the next couple quarters, that's always a warning sign, because if you go look at the 29 crash, it was really the recession or Great Depression started in the summer of 29, but the market ignored that and blew off.
So you think then that we are sort of heading for a key pivot point? We can't say it's going to happen next week, But as you mentioned, these blow-offs happen not exactly on the same day. One was the Nikkei was at one moment at the end of the year, and then the Nasdaq was in March 2000. But that would suggest that you think after, it's funny, next year is going to be 2020, a whole nother decade. So you seem to think then that the next decade could be much different from what we've been experiencing the past couple of years.
Yeah, I don't know. Like, I'm not a big fan of Elliott wave theory, but the one thing I always found interesting about them is they talk about like social trends and economic or stock market trends, right? And of course, again, you go back to the 20s, it was known for like, jazz music and there was a lot, even with prohibition, there was all these parties and prosperity, and then like even if you and then that kind of again, then that was representative of the decade. And the same thing goes with the 80s with certain fashion and music trends. And then again, and one of the trends was like the Japanese taking over everything. And then it was like the last trading day of 1989 that Japan like peaked, or like I said, in 1929. So it's kind of, for whatever reason, like this time around, we'd probably see it as low interest rates, a lot of quantitative easing, easy money, causing these kind of booms in asset markets. And it would just be interesting if there's this shift, away from that in the 2020s, and we see a rollover. And now the reason I don't think this is like, say, the 80s and 90s in the United States was that, the 90s saw kind of a continuation of the bull market, is because just where the valuations are. Again, you look at the market cap to GDP, which is one of the key indicators, in my opinion, it's back at the 2000 highs. So when you're back at those kind of highs, I don't see a continuation. Like, I don't see the 2020s being like the 90s and another 10 years of this. I see it more likely that this was like the 20s and it was a 10-year boom. Actually, last thing too, it's really interesting about the backdrop of the 20s and the backdrop today is what's going on today. Like, you've seen all this populism, because really you had these asset markets doing well. You had people who own stocks, own real estate doing well, but the majority of people have not done well since the end of the financial crisis. And that's why you're having, populists in the US and Italy and, the Brexit vote in the UK and all these things coming. And then, populist parties in places like France and Holland pull very strongly as well. And so, because the average person hasn't participated. Well, if you go look at the 20s, the top 1% owned almost the same amount of wealth as they do now, which is near an all-time high. So again, a lot of that prosperity just went into a few hands. And in the 20s, you had hyperinflation in Germany. You go look at the UK economy, it was actually pretty weak in the 20s post World War I. And then if you go look at, obviously Russia collapsed and became communist. So again, beneath the surface in the 20s, that boom was very fragile. And then when it totally collapsed, then you really had the rise of fascism and communism in World War II. And I think we have something similar today. Again, we have this asset boom. It's maybe papering over some of the problems that we are starting to see politically, but those problems will probably get way worse once there's some kind of, bust in the economy and markets, right? So again, the social trends are kind of similar as well. And like I said, for whatever reason, these trends kind of just summarize like a decade. Like the 70s was summarized by, high inflation and high unemployment. And that essentially ended, the inflation boom ended in 1980. So for whatever reason, they tend to end around the turn of decades. And, and then the 80s was kind of like, again, everyone was worried about Japan becoming the next global super economic power. And that ended in 1989. So I think this is kind of like that. But like this is going on in U.S. stocks in the 2010s. And that's kind of was my thesis of why not to turn bearish in the fourth quarter, because without a blow-off happening this past summer, I thought the blow-off could happen in the third and fourth quarter, similar to the Nikkei in 1989 or gold in 1979.
Well, that's looking way ahead. And right now, a lot of people can't look that far ahead. Right now, as we're speaking, there's approximately $575 billion worth of margin debt in which people are borrowing money to buy stocks A lot of these people, I'm sure, are betting that there's going to be a Christmas rally, end of the year rally. So I think, even if things get bad in a couple years, or next year towards the end of the year for that matter, I think you would agree that people right now are okay if we can get that end of the year rally. The margin debt gamblers will be okay for now.
And one thing I think that what people don't talk about when these booms and bubbles happen, people act like, everyone's greedy and everyone wants to get rich overnight. But I think what really happens to the majority of people, okay, there's a few people that were trading internet stocks like crazy in 1999, or this time around were like going crazy on crypto, thinking, Bitcoin was going to, 2 million or something, right? But I think that what really happens is most people just get complacent. And I'm a little guilty. I'm not going to say I'm guilty of it right now, but even me, I just kind of casually look at the stock market right now, or the S&P, American stock market, because I think it's in the midst of this. And I don't really have much exposure to the S&P, but I just think it's in the midst of this blow off. And with this blow off, you're just kind of like, oh yeah, it's up again. And it's been going up for 10 years. So you're just kind of like, more than getting greedy, you're just like, oh, whatever. The S&P has, gone up almost 5x in the last 10 years. It's going to continue to go up. That's what the average person thinks. And they just kind of get more complacent than anything else. So that's what I kind of find interesting about it, Mike, is that I like I said, right now I'm into that complacency. That's why I focused more recently on doing kind of venture capital for these small cap companies than talking about markets in my newsletter, because I'm kind of like, well, I don't think the S&P is going to really tank till next year. So, you just kind of don't watch it. Even with shorting, I'm looking more at adding individual shorts more in later in December, when I think, if you get potentially that first quarter top in the markets, you'll be able to short some of these things. And it's really interesting too, because like I said, one thing that we've seen is it's really just the major averages, these big stocks. We don't have like a trend like the 80s again in Japan, in the 90s tech. We the Nasdaq's done well, but it's like, got these big cap tech stocks like Amazon, Apple, et cetera, leading the way. We don't really have one theme right now. It's more just like, and the little niche sectors, like I said, like marijuana, like crypto have collapsed. So it's interesting just to see that we're seeing that it's really concentrated in these large cap stocks and the large cap indices. And I think that, again, leads to that complacency, because it's not like crypto was or marijuana was when they're hot, these things going up 100, 200% in just, a few weeks or a few months. It's more of just a slow trek upwards.
Well, maybe a reason for that is because so many people trade these ETFs nowadays instead of individual stocks.
Yeah. If you look at it that way, yeah, sure. Because if you're trading the spiders or the diamonds or the QQQs, what are you doing? You're buying the 100 biggest stocks in the Nasdaq. You're buying the 500 biggest stocks in the US. You're buying the 30 stocks in the Dow. You're trading these large cap ETFs, which have to buy those large cap companies. Or if you even trade the Russell 2000, that's smaller cap stocks. But again, it's got to buy those stocks that are in the Russell 2000. So yeah, and remember, we were both around during the .com boom. And what I found is, I've been through couple of cycles in junior miners too. I find that's more stock intensive. Like when we were around .coms, people aren't looking at buy the Nasdaq. They wanted to buy whatever, pets.com or the globe.com or, AOL, Amazon at the time, whatever was the new hot kind of .com stock. Now it's like, I don't really, other than maybe the FANG stocks, I don't really hear about that. It just seems that people just like, oh yeah, are just in the S&P and they want it to go higher.
Yeah, that's where we're at, and for now, it looks like it will, and we'll come back and see what's going on in a couple of weeks, and prepare ourselves for not only the next year but the next decade.
And who knows? By the way, Mike, maybe the crash in those little hot sectors like marijuana and crypto has even helped the S&P even more, because people are just like, okay, screw speculating on that small stuff, right? I'm just going to be in the market because those little speculative things like tanked. So that could also lead to even more money, just going into kind of the major the market averages. But I will say that again, that's what's differentiating this to me to this right now is that it's just people really just kind of focusing on those averages. And, like I said, we've been around for other bubbles. Like even when there was a little bubble in uranium stocks in 2006, I had people coming up to me at conferences at that time, talking about their little uranium stock that they really liked and stuff like that. I'm not really seeing that right now. I'm not seeing somebody come up to me saying, hey, I've got this great little video game company I like or something, right? It's like, it's just, it's just people owning the Nasdaq. And if they do own stocks, they own, again, the FANG stocks or whatever,
Well,
or McDonald's.
even with the stock market as a whole, I mean, it's kind of funny. 2 or 3 years ago, you talk about people coming up to you. You told me stories, and I experienced a little bit myself, where people would come up and talk about Fitbit, GoPro, and these kind of stocks, Tesla even, and now you never really have those conversations.
Yeah, because even like something like Tesla, which has done a lot better than, Fitbit or GoPro, but Tesla has been really like dead money, right, for years now. So it's like, you're right. And anyone who got sucked into those little IPOs, I think Fitbit just got taken over recently, but it's a fraction of what it was, right, when it went to IPO. So those stocks have all collapsed. And you're right. Again, I don't want to keep repeating myself, but that again could help the major averages, because the individual investor might say, okay, I'm not speculating in some IPO like Fitbit or GoPro anymore. I'm just going to buy the averages because, those continue to march higher. And then, like I said, there's ETFs all own the same thing. But whatever the case is, I just find it interesting. I'm someone who believes in cycles and trends. And maybe one mistake I made in 2015 when I did get bearish in the middle of the decade was I was ignoring that, this could be another decade-long trend. This could be like the 20s in stocks, 70s in commodities, 80s in Nikkei, 90s in tech, right? This is something that can now blow off into 2019 to 2020.
Yeah, so it's going to be an interesting couple weeks, and I know you're busy doing all kinds of stuff today. So thanks for taking the time to talk to me and everyone else, and all you people out there. Go to Dave's website, addictedtoprofits.net, for more info.
Yeah, thanks for having me.